Hey everybody, welcome to another free edition of our Trader User Group Weekly Roundup. This is for the trading week ending May 1st, 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is Tug O War, and that's what we seem to be having right now. This past week, the Dow was down just a little bit, about 22 basis points. Year to date, it's down a little, almost 17%. The S&P was down about 21 basis points for the week. Year to date, it's down a little over 12%. NASDAQ was down about 34 basis points for the week. Year to date, it's only down 4% or so. The Russell was the only one. We've had two back-to-back up weeks, and the Russell is kind of playing catch up just a little bit. It was up 2.2%. However, year to date, it's down about 24%. So it's been down a pretty good little bit. We did see the VIX finish out the week at 37.19. So it moved up a little over 3.5% for the week. Last week, I think it came in at 35.93. So it's still in the mid 30s, still higher than I'd like to see, but I suspect it's going to remain so for a little bit of time. Meanwhile, on the world stage, most markets finished higher with the exception of the FTSE. Remember, most of the markets were closed on Friday. So going into Thursday's close, most markets were up. I suspect Monday some of them will come down and sell off based on our Friday's market action here in the U.S. But the FTSE was the only old holdout, finishing down for their short holiday week of 19 basis points. But most others were up strong. The CAC 40 was up over 4%. The DAX, the German market, was up over 5%. Nikkei was up 1.8. China was up 1.8. The Hang Seng, or the Hong Kong index, was up 3.4%. So most of the holiday shortened week for the rest of the markets last week was good. And then here in the U.S. for this full week, energy back-to-back wins. I mean, XLE, or the oil and gas energy, it was up 3.17% for the week. Utilities back-to-back again, the worst performer 2 weeks in a row. It was down about 4.14%. And looking at the trailing PE ratio, it's at about 24.18. The forward PE ratio is 21.75, so it's lower by a little over 10%. And then just looking at the annual dividend yield of the S&P, it's 2.14%. The 10-year interest rate's at 64 basis points, so that still funnels money into the S&P because the overall dividend yield is higher than you get on the 10-year. And in search of yield, you'll see money kind of move that way. But, remember I said earlier the market's kind of in this tug of war. Well, the U.S. economy, really, while it's free falling, according to government economic data, yet the market's just finished one of its best months, going all the way back to 1987. Okay, NASDAQ led the way. It was up a little over 15% for the month of April. Dow was up over 11%. The S&P up almost 12 and a little over 12.5%. And since the lows that we had here on March 23rd, most indexes are up over 30%. Now, contrast that with the economic performance numbers that we're getting out of the U.S. here. So far, about 30 million people are out of work. We saw GDP this past week, come in a minus 4.8%. And while that's bad, the Eurozone's even worse. Their GDP came in at a minus 14.4%. That's horrible, guys. And and keep in mind, this is Q1, which only 1 month out of the 3 months really included the full effect of the COVID virus. Q2 is going to be even worse. So God knows what that's going to come in at, and what the slowdown is going to do. So we've got this tug of war going on with the market price performance and the economic data that's coming out. So, what's going on here? I mean, I've talked about this before, but basically the market price action's making a huge bet that we're going to see better days ahead. Okay. And then once the recovery starts to happen, people are going to come back to work. They're going to be spending more money. And it's just going to help the economy improve quickly. And it's really also helping with all this is a tremendous amount of liquidity, a little over $2.5 trillion. But then if you add in what can be loaned out via the Fed lending facility, then that drives it up to about $7 trillion in liquidity that is available for the equity markets here in the U.S. So we've got a combination of strong fiscal and monetary policy just dumping a ton of cash and liquidity into the market. So all of this is designed, though, keep in mind, for shorter term, not necessarily longer term remedy. okay, because the markets have to get open. And we're already seeing 20, 22, 23 states starting to come up with opening plans here. And the other thing that's really not truly factored into a lot of the economists' forecasts is the potential vaccine and other prophylactic drugs that can help increase the confidence level of consumers, So we throw all of that in, and that's why the market price action is moving higher while the economic data is showing a lot of ugliness. Now, we got that in '08 and '09 too. While we were still in a full-fledged recession back in '08 and '09, markets started moving up well before the data started improving. But that's just the way the market price action works, okay? But given the large bounce off the March 23rd lows, I'm just looking forward. I would expect market conditions to kind of cool down a bit. We're going to see price action kind of run range bound, a little bit choppy with fits and bouts of up moves and down moves. A lot of it dependent on news action on how fast we can get the markets open again. Possible drug and vaccine issues. We just saw Gilead come out with their remdesivir last week, getting FDA approval. So all of these things are going to play into consumer confidence. Keep in mind, consumer spending and confidence levels are very low right now, and consumer spending is 70% of the GDP here in the U.S. Okay. In Europe, it's about 60%, high 50s. But here in the U.S., it's all about consumer spending. So if the consumer confidence is lifted and it moves higher, which I think really more testing and drugs, prophylactic, and then vaccine drugs, that's going to dramatically change it. We're going to see a fast recovery. But until that happens, we're going to see sideways, mostly chop. So that's why I'm saying it's kind of a tug of war market right now. So, we also have to see this nationwide stay-at-home mantra. We're seeing technology companies hold up a lot better in this kind of work-at-home kind of crowd. We're seeing some of the key technology companies like Microsoft, Amazon, Facebook, Apple, Google. All those represent about 20% of the S&P right now. Okay. And it was only back in the 70s where energy markets represented 10 to 15% of the S&P. Now it's less than 3% of the S&P because energy has just really gotten killed. And we've seen this change in market dynamics over the past half century mark, where technology is really just driving everything. The secular growth is just moving things really nicely. And it's changing the way the markets react to different things. So you just kind of have to keep that in mind. Also, the other thing moving forward, I think you're going to see stock picking firms do a lot better than, say, passive index funds, which just invest in the broad market access, because you were going to see stock picking firms come out and pick some of these companies that are going to be the winners 3, 4, 5, 10 years from now, mostly in the technology field. But there really, if I had to kind of list it out, there's really 5 major technology innovations, and there's going to be firms in each one of these that are going to really take off. I mean, if we look at the 5, I see DNA sequencing in the healthcare as being huge. It's going to drive a lot of different things, robotics and AI. Those are robotics is one, artificial intelligence is one. I think energy storage and use, meaning battery storage and just the use of energy and power and how that's going to be done. There's going to be a lot of technology innovations in that side. And then, of course, let's not forget blockchain technologies. I mean, people tend to forget that, but a lot of these are going to be driving a lot of the technological revolution over the next decade. And there's going to be companies in each of these that are just going to be taken off. So we're going to be watching these as well. So this is kind of what we've got going on in the market as we speak. Now, for the shorter term traders, day traders and things like that, we've got a solution with one of our trading indicators that we use, and we're working on it with a group of some of our users to codify it and make it a little bit more powerful than it is. So we'll have the IP on that shortly. That should be really interesting also for traders. But looking at the chart right now, you can see we're looking at the Ichimoku, my favorite, the 240-minute chart. You can see it's kind of an X-ray view of a daily, not quite a full trading day, but it gets close. You can see here that this was, for a long period of time, our R1 zone, and this was our S1 zone right here. These are just trading zones where the markets tended to fluctuate around okay? And you could see the price action around these zones, okay? Now, when we broke out here, this initial breakout, I said we'd have a retest. One bar was really too quick. But then when we had a breakout right here on this bar and then a retest and then a move higher, I said, okay, we're going to see a run up to the 29.73. We almost got up there because we had almost 3 full days of just solid running higher, really quick. It just moved up. And now we came down, we did a retest. We spent a little bit of time there. We broke through, which now shifted from an S1 zone here to an R1 zone, meaning the first level of resistance. And we're down right around the cloud, and if we look at the cloud, it's sitting at that psychological barrier of 2,800. Remember, anything divisible by 100 in this S&P is a support or resistance level depending on the direction from which you approach it. So that would be 2,800, 2,900, 2,700, and so forth. And then our S1 zone is just below right here. Okay, so I had said that if we come back and break through here, then we're probably going to come down and test this area here. If that holds up, we're going to come back up and we're going to be sandwiched in this wide zone right here. So generally, when you get sandwiched in a zone like this, you're going to be looking for a reason to break out, or price action is going to be looking for a reason to break out. And you can see even going all the way back here, since the middle of April, we've been kind of sandwiched. And when we do break out, we don't have enough escape velocity like we do here to maintain it. And then we come back in and we usually find support back in the S1 zone here. So we're going to be in this range here until we find a reason or an excuse to break out either to the upside or back to the downside again. If we break out to the downside, we're coming down to the 2,700 is the first psychological test because it's divisible by 100, and then we're going to just keep right on coming down, right? It will probably come down to the low 2,600. This is a prior pivot point level right here. Now, looking at the Ichimoku on this 240-minute chart, I will say that notice here, we did have a small green red here when we were moving up right in this area here, right? And then when we got all the way up here, we were still red right here. And over in this area here, this suggested a little bit of downside in the future, and that's what we had. Now we've got green here on the future, so this suggests if we get in here, we're going to have chop, and then we're going to come back up in this area right here next week. If we break this 2,800 level right here, we're coming down to test this S1 level, okay? Now notice that is a fib node right there. On this chart, this fib node is a Fibonacci retracement. I'll show you another chart that's got a Fibonacci extension. On this retracement, it's sitting at 2752. That retracement level is, you've got to define with your fib nodes, either extensions or retracements, it does not matter. You've got to define a pivot high and a pivot low to define the range. If you cannot define that pivot high and pivot low correctly, I don't care what you do, those fib nodes are just not going to work out for you. So what did I do to define this fib node here? This is a long-term fib node, and it is designed to go out over a year in case we go down much lower. And that fib node, the pivot low was made on March 9th, 2009, okay? And then which was the lows in 08, 09 bear market. And then the Feb highs that we made here in 2020. So I've got the fib node really placed here. So this is a long-term retracement node right here on this one. And you can see that it would serve as a little bit of a minor support below the 2,800. It's kind of sitting between the 2,800 and this level right here that's in a yellow dashed line. I use that on my chart to define pivot points, which are defined by key price levels where bulls and bears equalize before they shift and reverse trend, okay? So we've got a lot of support underneath us, but should all of this mess break, we're coming down, guys. And it could be a nice little run down. But that's kind of what I'm looking at on this chart. So what I want to do here is just kind of erase everything. I'm going to take you over to Fibonacci extension chart. This Fibonacci extension chart is off the lows. Now, if you'll notice on the Fibonacci extension chart, it looks a little bit different because we've got different nodes that we're looking for here 29.31 is at the 6.618. Now this was defined near term off the highs that we made, all-time highs, and the lows we made on March 23rd. And then I just extended upward, hence the fib extension off the bottom. And you can see here that generally when you get over the 50 percentile level, generally the odds favor it not coming down and making new lows. Okay, when it comes down and make new lows, it generally finds somewhere in this level right here. All right, maybe north of the 38 extension. Excuse me. No, I don't have COVID-19. But it usually does not exceed the 50 percentile level. I'm going to get a drink of water here. Just hang on 1 second, and let me just mute my mic for a sec. Sorry, guys. I just swallowed coffee the wrong way. I didn't have Bailey's in it or any whiskey in it. Unfortunately, just coffee. But you can see here off this extension where we've gone. Now, notice on this chart, I've also included the 200 EMA and the 50 EMA. We're sandwiched right between. We could not break out of the 200 EMA. Normally, in a bear market, the 200 EMA is above the 50 EMA, which is what we got. It happened right here, right around the time of the lows. And generally, I always like to say that is like a bug zapper. That crossing point, the markets, by time it's crossed, the markets have already come down a good deal, right? It crossed almost right around our lows. So the markets are in a rebound mode up until around that cross, but we're running into problems right here. And now notice we're sitting right here on the 50 EMA, just sitting right on it. And now I would not be surprised to see us come back down and test this level right here. All right, so we've got a couple of different charts that show a couple of different levels. But if you put the two charts together, they're fairly close. On both charts is where the support level is. I don't know, for me, to be able for us to get up and get a little bit more bullish activity, I was expecting a run right up to about the 3,000 level. All right, we didn't quite get it during this run right here. When we had a little bit of a false breakout of the 61.8% extension off the lows on March 23rd, I figured that once we broke that, we're going to quickly come up here, and that's when we would hit our resistance and come back. But we found the resistance at that 200 EMA, and then we came back down here, and it had really an ugly Friday. Okay, I mean the markets were down about 85 points, or roughly the futures, almost 100 points. We haven't seen that in quite some time, right? So, generally when you have a move like this, the momentum can continue for a day or two. But I don't expect us at this point in time going below this extension level right here for the near term, okay? I don't see it just yet. Doesn't mean it can't happen. And based on the odds of taking out this level right here, this fib node, which is the 50% extension off the lows, generally when you do that, you do not make new lows. So if you go back and look at prior bear markets and then you do extensions off the lows, generally you do not get a 50%. Once you get over the 50% extension off that low, you do not get a return to lower lows. The return to lower lows generally happen when you get up to the 0.38, maybe just a little bit higher, okay? And then you get that bull trap, and then it sucks you in, and then you roll right back over again. That's not to say it can't happen here. I've heard some people say, is it sell in May and go away? Well, if you really think about that saying, it's designed to be around summertime, and it's designed to be around people freely moving in an economy and a culture where they can go out and do everything in the summer, go on vacations and all that, so there's less trading volume. But in this case, there's still a lot of lockdown. It's anything but normal. Okay, so the sell in May at summertime, let's all get out and go on vacations, is not going to happen this time. Yeah, I think people are cooped up, so you're going to get as a warmer weather comes and states start to open up, people are going to be going outside. But I think the let's take the family on a Disney vacation is probably going to hold off this summer for quite some time. So that sell in May and go away mantra in my mind does not work for this particular bear market. So that just means that we could see a lot of chop, as I said, going forward for the next 60 days. Over the next 60 days, we're going to we'll get through earnings, and then we will see exactly what the opening of the economy is going to do. Now, if we have an opening in a state and then they have to close it again because the virus starts to spike and we're not making any progress on the vaccine or the prophylactics designed to help people who are already sick or getting sick, then you're going to see the markets come over and possibly make new lows. All right. But short of that, I don't think we're going to be making any new lows. That's a little bit about what I'm seeing right now in the marketplace as far as where things are flying. Now, if we come over, the other thing I wanted to show, I'm going to just switch my screens just a little bit here. And let me do this right here. Let's just move over. Here we go, right here. Let me just take us over to this screen right here, which is a Bollinger Band view of the E-mini S&P 500 futures. And it's going to take a second to paint on your screen. But on my Bollinger Band view, I want you to notice I've got 3 lines on the Bollinger Band view instead of 2 because I've got 3 standard deep. The price action is still above the center line of the Bollinger Band, which is the yellow line, okay? So you can see the expansion of the Bollinger Bands when volatility just went batshit crazy. And then the contraction here. Vol is still contracting. So as we move forward, the other overarching theme you can see, if you just kind of step back, you can see the move down and then the move sideways like this. And these Bollinger Bands are going to continue to contract. We're still going to have this kind of chop, but it's kind of had the big move here. And now we're moving kind of in this direction. And we may get a chop up, we may get a chop down until we get a signal that says, let's start moving higher, back over 3,000 or back below the 2,500, 2,400 level. All of that is going to be determined by how quick we can get the economy open and just where things are going to go from here. So you just have to think about it that way. There's a lot for our members. We're going to be going through some of that indicator that we use to help us out a lot, developing bias using fractals and time and things like that. But it really makes it very simple to use. And even for day traders with small accounts, you can just use it. And we go through examples of how you can use it just trading the SPYs or the diamonds. Really nice. But looking at the chart and the Bollinger Band, you can see how this thing is just moving forward on the entire over the entire duration of COVID. Okay, now if we come down and we look at volatility, I'm going to show you a couple of different charts. The first thing I'm going to show you is just the VIX itself. Okay, so if we just look at the VIX, and I'm going to switch my screen over here, so it'll take a second to paint the screen here. So let me just get it over here. Where are we? Right here, screen 5. So if I take you over here to this screen, what you're going to see is a daily chart of the volatility index VIX, which is just the CBOE's 30-day view. Theoretical 30-day view of where volatility should be. So you can see the VIX made a high here of 85.47, not quite as high as the intraday high made during the 08 crisis of 96.40, but we actually closed a couple of days in the 80s here, where in 2008 we did not. But you can see that slow, steady movement lower. So that just means that, as I showed you in the previous chart, market price action started to settle into a range, possibly a choppy one, but a range nonetheless. We're in the red zone. We're out of the black, which is what I call the black swan area. That's why I've got this color-coded chart right here. Different option strategies tend to work well in different color codes on the chart itself. So you can see here We actually almost got into the very low. I think the low of the day, or the intraday low, was actually 30.71. And that was back in the middle of this week on Wednesday. And then we came back up because I don't think volatility is ready to give it up. Now, remember what I said. Once volatility gets into the black swan area, it takes months and months for it to get back down below 30. It just takes a long time because the market's very sensitive to any contra trend moves, any bull traps, even big moves higher. You'll see vol come down a little bit, but it's not going to give it all up. Not until we're well past and the economy starting to right size itself. If we look at the front month skew, you can see on the front month skew, we actually, on this daily chart, we're in the green. We were actually in the green this past week, which showed us in a contango environment. And then we move back into a backwardation again on the front month skew. So we haven't been in a contango environment going all the way back to February 20th. So we switched back into a contango environment basically on April 24th. And we were here for a few days, and then we moved back on Friday. So last week we started to right size some of the term structure and volatility. And if we look at the back month, which is June and July futures, we're still in a backwardation mode, which means the June volatility futures are higher than the July volatility futures. So we've still got a backwardation market going out this year, and that does show a lot of danger of what we're running right now in this market. So just understand there's still a lot of fear in the markets, and we can still roll over. So we're going to be in that chop mode for quite some time. And then, of course, if we look at U.S. Treasuries, Treasuries are still very high. I mean, we're at 181 and 12 ticks here. We've been kind of running sideways. What I've been saying is if bonds move up, I'm going to be more of a seller of bonds than a buyer of bonds. Okay, meaning I would be more interested in going long interest rates if bonds get ugly right up in this area up here, meaning they're going higher. Okay, and if we look at interest rates, they're down. The 10-year rate is down fairly low. But we're seeming to find a bottom here right now. Now remember, it's a little bit of a false market because the Feds are in here just pumping liquidity every day into the markets. They're doing repo facility to the tune of over $1 trillion. They're keeping a lot of liquid. They're keeping the markets very liquid, and that's helping out here. And it's helping the bond market. It's helping the muni market, the municipals. They've even come in and gotten into, dipped their toe into the water in some of the junk market, junk bond area, the high yielding debt. So that's put a lot of liquidity in here, and it kind of calmed the market down. So I think we're going to run sideways here for a while. I think I saw a 90% probability that over the next 3 years, inflation is going to stay tame and mild. Based on the way the Fed fund futures are pricing things out right now, which again does not surprise me. And then of course, if we look at the US dollar, you can see here this big dollar run up right here was during the COVID-19 crisis. It was a rush for everybody to own dollars, especially other world currency, or other world banks, sovereign. Everybody rushes to the dollar. It's still a flight to safety in times of severe stress. And then you can see the Fed stepped in here because the dollar was getting too strong and did reverse swaps, which basically means they were selling dollars and other countries happily bought them up. But doing that brought the dollar back down, and now we're in this sideways pattern here. I think we'll kind of stay in this choppy range for a while. Okay. And then, of course, if we come down here and look at gold, gold has been in this wide chop range right here. You can see going back to really the beginning of April, almost for the entire month of April. We did have a run up to 1788. We had a run down to 1666, so a 200-point move. We've been in this 200-point range essentially for a little bit of time. I mean, if I were to put it on the chart right here, you could just see right in that area right there. We've been in this wide range here, back and forth, back and forth. Now, if that forecast holds true, that inflation is not going to go crazy with all this money in the markets right now because commodities are lower, oil is lower, nobody's spending money right now, and if they do, they're kind of consumers are spending more. That tends to be deflationary in nature, not inflationary. It's going to keep it's going to suppress bonds for gold for short term. Longer term, I like gold over 2000. Okay, once inflation starts to come back in, and you never really know, it's just a guess. So we're going to watch gold, but I think right now would not be a time to go long if you're not long gold. There are ways to get into it for our members. I'll talk about it this Sunday, and ways to play it longer term without getting chopped to death. So we'll talk about that with our members. Let's look at oil. Oil was up. I mean, you could see oil after this. Here's the zero rate right here, the purple line. You can see what it did. It went down to minus 40.32 just because of storage issues. People were paying people to take oil from them because they couldn't store it. And it cost them more to store it. It's just a mess. But now you can see oil is back off the lows here. This is the front month contract in May. The May futures contract. So we want to watch the May futures to see if, as we get closer to expiration, as people need to get rid of some of their oil, does oil tend to move back down again, or is it going to hold steady state? So watch that really closely. All right, that's kind of where we want to pay attention to. All right, folks, that's a little bit about where we're sitting right now for our members. I'm going to go with you through some really interesting stock plays that we've got, others that I'm looking at, and then we'll take a look at some of the commodity markets here that may offer up some opportunities for us. If you're a non-member, I highly encourage you to come in, check us out. And our option masters, we're doing a lot of cool things with all this stuff in this crazy market. Have a really great weekend, everybody. Members, I'll see you tomorrow night for our weekly market watch. Take care, folks. Ciao now.